Today we're going to look at an example of cash basis accounting versus accrual basis accounting. If you read through the module, you know that cash basis accounting is basically when we book transactions when cash is exchanged. Accrual basis accounting says that we book transactions when value is exchanged, basically when we earn revenue or when we incur expenses. The cash basis is not a generally accepted accounting principle or GAAP. So if we are doing GAAP financials, which is what we'll be doing in this course, we must use accrual-based accounting. Cash basis is acceptable for some small businesses, and it's how a lot of small businesses report for tax purposes. So if they're like my dad used to be a barber, his barber shop, he kept his books cash basis, and that was fine because he was a small business. But let's talk about the difference. And the difference is really just going to be a timing difference. So I want to illustrate to you how when we use cash, whether we use cash basis or accrual basis, the numbers end up being the same once we've gone through the whole cycle. It's just a difference as to when we recognize, in this case, it'll be revenue. So our transaction is on January 1st, Amazon sells a 6-month Prime membership for $60. I don't know if any of you have Amazon Prime. I do. I pay once a year, but once a year was going to be a lot of journal entries to go through. So we're going to do 6 months for $60. Okay. Under cash basis, Amazon would recognize revenue when they receive the cash. So on January 1st, 2020, they're going to debit cash for $60 and they're going to credit revenue for $60. We'll enter our transactions here, 01/01/2020, and they're going to debit cash for $60, and they're going to credit revenue for $60. And if we add that up, then they're going to end up with $60 in their cash account and $60 in the revenue account. Pretty simple. Okay. But the reality is, on January 1st, Amazon has not delivered the service that they are promising when they sell Prime membership. When I buy my Prime membership, if I bought a 6-month membership, I expect 6 months of free 2-day shipping. I expect 6 months of Amazon Prime Music, Prime Video, and whatever else you might use from Amazon. Those are my main things. Okay, so under accrual basis of accounting, we need to recognize revenue as we deliver the services. And in this case, it's going to be once a month we'll recognize revenue. So at the time that that Amazon sells the 6-month Prime membership subscription, they are going to debit cash because they're still getting my cash on January 1st. But they're going to put the $60 in a liability account. The liability is called unearned revenue. And unearned revenue is a liability account that we keep that says, hey, we owe something. We still need to deliver goods or services, so we have a liability to our customer. In this case, Amazon has a liability. They owe me 6 months of free 2-day shipping and video and music. Okay, so on the day that we make the sale, or that Amazon makes the sale, they're still going to debit cash for $60. Only this time, they are going to credit their liability account, unearned revenue, for $60. Then at the end of January, when Amazon has delivered 1 month of service to me, they are going to recognize 1/6 of the revenue. Okay, so $60 membership, a good over 6 months. So each month they will earn $10 or 60 divided by 6 worth of revenue. So on January 31st, they're going to debit unearned revenue. So they're going to reduce their liability by $10 and they're going to recognize revenue of $10. And let's go here. So we're going to reduce our liability by $10, and we're going to increase revenue by $10. All right, so I'm going to just add these things up. So you can see how the balances change. Okay. So you can see after the first month, our liability now only has $50 in it, and our revenue account has 10. At the end of February, we're going to do the exact same thing. Amazon's going to recognize another $10 of revenue. They're going to reduce their liability by that same $10. So let's put our dates in here. And in our T account, we'll put 10 and 10. You can see now after the second month, our liability, our remaining what Amazon owes, is only $40. And they have now recognized $20 worth of revenue. So I'm going to do the rest of the months here real quick. So that we can get to it. I don't think I need to explain every month. I suspect you guys get what I'm doing. Okay, so at the end of March, we're going to book the exact same entry. Oh. And now we're down to $30 in liability, $30 in revenue. And we'll do it again for April, May, and June. Okay, so you can see at the end of June, I've used up my membership. Amazon doesn't owe me anything else. They've delivered everything that they were supposed to give me. So by the end of June, they end up with a debit balance in cash of $60,000 that I paid them back on January 1st. They end up with, or not $60,000, $60. They end up with the whole $60 sitting in revenue, same as cash basis, and the liability account, once they've delivered the 6 months of service, is $0. So under cash basis, we end up with $60 in cash and $60 in revenue. And under accrual basis, we end up with $60 in cash and $60 in revenue. The difference is just timing, when we get to recognize that revenue. All right, so we will be doing accrual basis accounting for the rest of the semester. This is the last time we'll talk about cash basis, but it's important to understand that cash basis is out there, that it is a viable option for very small businesses that don't have bank loans or external shareholders. And I guess that's it. All right.